I'm in my fifth day of the COVID virus and first time I've had it, so I'm having some difficulty concentrating, but I wanted to get this video out, and it'll be a short one just because I think it's important to keep in focus what is happening and what is probably going to happen in the future. I think we live under the illusion that if we bring interest rates down, it will stimulate the economy because consumers will buy more and everything will be rosy. But I think history tells us a different story, and I don't think anyone is sharing it with you. I have here four elements that I think I want you to focus on. The first one, of course, is the S&P 500. That's the measure of how successful we are doing as investors if we stay invested. The second is the national debt. As you can see, our market is driven by our debt. It's what puts more money into the market so that we have more money to spend on stocks and investments. The third is interest rates. And here you will see them reflected in the inverted yield curve. Everywhere you see these blue marks, you see that the yield curve is inverted. That is to say that you can make more money lending money to the government for a shorter period of time than a longer period of time, which is inverted. That doesn't make sense. But you can see here, we've been inverted for quite some period of time and can't seem to get out of it. And then what I really want to focus on is the belief that Jerome is there to help us stimulate the economy by giving us lower interest rates. And historically, that may have been the case, but in the last 20 years, that's not the case. Interest rates, lower interest rates, are there to save the economy. After we screw up, they come in and save the economy. And let me show you exactly what I mean. If you go back and look at the interest rate movement, as you can see, we go back to 1993. Interest rates are low and staying low, and then they start to go up. Notice what happens on the S&P 500. As interest rates go up, the S&P goes up. And then they level off, and the S&P continues to go up, and then the economy gets stupid. Overvalues a bunch of dot-com stocks and gets crazy about it. And so, again, interest rates continue to go up, they level off, and then we get in trouble. And the economy is in trouble, overvaluation, and to save the economy, the Fed starts lowering interest rates. That's when they lower interest rates, to come in as your big brother and save your ass. That's what they do, okay? They level off, the economy goes along, then they start to build them back up, and what does the economy do? It continues to grow, and they level off, and then what happens? The banking system gets all screwed up. They start charging exorbitant fees and creating stupid packages for people to borrow homes. And then the economy gets screwed up and we have a banking crisis. And so what does the government do? They bail us out. They start lowering interest rates to get the market straightened around and to bail us out, to get everybody out of foreclosure, to get things started up again. Then on the other side, the Treasury starts issuing more money to stimulate the economy. Interest rates stay low. Then they start to climb up again. And then a pandemic occurs. And so what does the government do? It issues more debt and lowers interest rates to come in and save the economy. And then once they get it saved, they start raising them again and leveling them off and sitting on the sideline and letting the economy run its course. And the economy stays with inverted interest rates. And Jerome does nothing. Jerome will not do anything until the economy gets screwed up. And what would screw it up? Well, could be a war in Ukraine, could be the government shuts down because they're squibbling with each other, could be a commercial banking crisis. It could be any number of things. Hell, we got enough potential problems. You got Israel, you've got the Red Sea, you've got Taiwan, you've got China's economy. I mean, the opportunities for Jerome to come in and on his white horse and rescue us by lowering interest rates are numerous. Take your choice. But the reality is he ain't going to do it anytime soon because the economy does not need stimulating. The interest rates will come down when the economy needs them to come down. And it's the Federal Reserve's life preserver, as is witnessed one, 2, 3, 4 times in the past. Is it going to be different this time? The economy's going to be doing good, and Jerome's going to come in and say, I'll just make it better? I don't think so. Because if he does, he then expends all his ammunition. He has no way to save the economy when one of the 4 things that could happen does happen. He'll have no ammunition. So do not expect interest rates to come down. He can't afford to take that risk. So be aware. They're aware that the future is precarious right now. This is the scariest times that we have seen. We're in a position of, are we going to fund the war in Ukraine? Are we going to fund the war in Israel? Are we going to defend Taiwan if China goes and takes its largest asset available to it right now, thus to save its economy? Or are we going to spend our ammunition just to make Wall Street feel good? It ain't going to happen. So expect this line to find its way down. And then interest rates will come down to stimulate the economy. Now, does that mean AI isn't going to happen? No, that does not mean AI. AI is going to revolutionize our world. But we're going to have some opportunities to buy into it. Look at your big tech stocks. I bought some Google today because I know that Google, who owns DeepMinds, will be one of the 2 major players in delivering AI to me. Actually, 3 major players. It'll be Google, Apple. See there, I can't concentrate. Okay, I'm going to cut it off there. This is my take for you. I'll keep trying to share as best I can. If you want to be a part of this, join our tribe. You can figure that out.